Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. I'm your host, Andreas von Hirschhausen, and with me today is Colin Lancaster. Colin is currently the global head of discretionary macro and fixed income for Schoenfeld Strategic Advisors, a global multi-manager platform, and the CIO of Matador Investment Management, an absolute return hedge fund. Previously, Colin was the head of macro strategies at Citadel, and before that at Balyasny Asset Management. And Colin also holds a Doctor of Law at Marquette University Law School and a Bachelor from Princeton University. Colin is also the author of Fed Up, Success, Excess, and Crisis Through the Eyes of a Hedge Fund Macro Trader. In this book, Colin tells the story of how he experienced the COVID pandemic, the panic, and the market crash in 2020. Colin, welcome to the show.
It's a pleasure to be here. Thank you for having me.
Let's start. How do you correctly say the last employer that I completely butchered?
Yes. It is a firm called Balyasny Asset Management. The founder of that firm is a gentleman named Dmitry Balyasny, who's one of the icons of the hedge fund world. So he's a very famous hedge fund founder.
Okay, awesome. Now with that now taken care of, you are a global macro hedge fund manager. What exactly is global macro? How would you define it?
Well, I think it's a great question and a great starting point. The simplest answer is so much of what people focus on from an investing perspective is typically the equity markets, so investing in companies themselves. The great investors in that space will do a tremendous amount of work on the prospects of companies, their future growth, their business model, whether they have a competitive advantage or not. Global macro tends to be a lot different in that we tend to make our investments in either the global interest rate markets or foreign exchange markets. And if you think about all of the work that great equity investors are doing on companies, we're doing the same thing, but on countries. So really thinking about global economic cycles, looking at data, maybe that's inflation or employment or housing or consumption, understanding where the world's central banks are in terms of accommodating different stages of a business cycle, and making our investments based on those views. I think what's really interesting is that most large investors, those that, investors that come to us wanting us to invest on their behalf, are looking for diversification away from equity exposures. So we're expected to provide, correlation benefits within the context of a broader portfolio.
You mentioned one thing, basically looking at countries. And one thing I notice in your book a lot is that you speak about employment figures, for example, right? Maybe let's start with why is exactly that number something that you seem to look at all the time? Because in your book, okay, we were just waiting for the employment figures. They were bad, they were good. Why does this theme come up over and over again? And is it one of the most important indicators that you look at? Or could you describe a couple of other indicators that play a role in your trading decisions?
Well, it is one of many things that we look at. I think one of the easiest ways to describe why it is significant is the fact that, most central banks, the Federal Reserve in the US, the Fed is the largest of the world's central banks. And if you think about their dual mandate, they are supposed to be focused on two things. One is the labor market and full employment, and the other is price stability, which is a fancy way of saying making sure that inflation is not running too hot or too cold. So data that feeds into those two things, which are their dual mandate, tend to be very important. And Payrolls, for example, which comes out once a month, in fact, we just were through the last cycle, came out last Friday, does tend to be something that still moves the market. The market participants really react to what the labor market is doing. And that drives global interest rates, and that has an impact in the foreign exchange markets, et cetera. But the jobs number tends to be something that's still really exciting in our business.
Let's dig into a typical payroll announcement day, right? How does it usually look like? Are you setting yourself an expectations? I expect payroll to come in at X, and then if it comes in at above X or below X, then you start trading, or you're setting up the trades in a way that you profit when payroll comes in as you expect.
Yeah, look, I think with anything, what you're trying to do in macro is to look for mispriced events across the market. So if you have a view that you feel that, look, the economy is on more stable footing than the market really expects, then you're looking for expressions of that type of trade. So payrolls is one type of way to have a series of catalysts that you can say, boy, I think the labor market is going to run hotter than people expect. And you can express views based on the work that you have done. I would say that a job summary that tends to be a bit of a noisy type of data series, in that you can have large beats or misses. So some of this is noise that you have to kind of factor out. And the payroll number for the previous months are always being adjusted as well. So you have to take that into account. But for global macro, it's still one of these big events that happens each month and people get excited about. And it is something that I cover quite a bit in the book, because particularly during the pandemic, you saw this enormous, external shock to the system. And you just saw the global economy really just completely collapse. So when you saw the number of people that were being forced out of work and were being laid off, it was just amazing. There's a scene in the book where the main character talks about the data being so poor, it looked like these must be mistakes, because you saw this collapse in economic activity, which was really the equivalent of what we saw in the Great Depression. And all of this happened in a matter of weeks. A typical economic cycle is going to play out over 6-7 years. And here it was all condensed into such an incredibly short time frame. It was just a really remarkable period.
Okay, so then basically you have a broader theme for how an economy should do. And then actually to stick, for example, with payroll or any other indicator, right, GDP results, they are more like a catalyst to push your trade into the right direction. They're not more like a trade target in itself, but they are more a catalyst to lead towards the direction that you're going at. And then, for example, could you give some ideas of what instruments would you use to do a certain trade? Is it also, do you use futures? Do you use options? Do you use just buy FX outright? What are the typical instruments you use to take a view, to take a stand?
Yeah, one of the unique things about global macro investing is that we tend to have a very broad mandate. At the end of the day, we're able to express a view in, a number of different asset classes. Maybe that's in interest rates or in FX or in equities or credit or commodities or the volatility markets. In terms of that mandate, it is what I like to describe as the blessing and the curse of global macro. Because for any view that you have, there may be 20 or 25 different possible expressions about how you want to express that view in your portfolio. And what one of the most painful things for a macro investor is when you've gotten the view correct, but you had on the incorrect expression. So, in our business, you've collected style points, but not P&L. You haven't profited from that, which is always quite a painful type of experience. And to your question on, how to express that trade, a lot depends on what your own conviction, your own certainty, how you want that to fit within a portfolio, because maybe you want to express it in terms of some type of option structure to give you more defined downside, but with upside convexity. And or you can just have a delta one position, so it's kind of like spot FX. So, but you can be right or wrong in a more linear type of fashion in terms of your expected P&L on that. And all of those things become very important. How you structure a trade, the time frame that you want to be in that trade for, how it fits into your portfolio. Is it additive to risk, or is it somehow a diversifier to give you more portfolio diversification? But all of these things are things that you learn over time. It's my 25 years of being in the markets and honing your skill. And I would say one of the most fascinating things about markets is you never graduate. You're always a student of the markets. The markets are always evolving. They're always changing. And you're forced to be a lifelong learner to be able to keep pace with markets. But to me, it's something that's really exciting about what I'm able to do for a living. And at the end of the day, I love my job.
That's really good. It is. I think it's really important, right? Otherwise, you wouldn't want to stand in such a hectic environment. And I want to dig into market trends a bit later. For now, I would be really interested because it struck me as very odd, because I usually talk to asset allocators, to even high frequency hedge fund traders, right? And there it's very linear. You have a view, you take a position, and either your view is correct or it's not. And then your position goes that way or it doesn't. But could you give an example on how you could get the view correct, but the instrument wrong, that actually your trade doesn't turn out well?
Well, it's a really important part of our business. You would think, and here's a good example, that in a world where the Fed is going to allow the U.S. economy to run hot, we are going to have more fiscal spending done via an infrastructure bill. You would assume that long end interest rates are probably rising, right? That would make sense, that the curve should steepen. But if you look at what the curve is doing right now, it's flattened a great deal. So if you think about that, in a nutshell, that is a risk-on type of view. Now, I could have expressed that view by buying tech stocks, which have performed very well. I could have expressed that view by putting on curve steepeners, which in theory should have worked, but have not worked at all in this environment. I think that's a good example. That there are different ways to express, whatever view that you have conviction in. But you need to make sure you get that expression correct.
So you have like two variables in the whole thing to make the whole game even more complicated. As if it's not complicated enough, I like to listen to the Howard Marks memos, and he always says he stays away from economic data because he's just he's one of the smartest people or investors out there, and he says I can't understand it, I can't make sense of it, so I guess I even have to get the trade right as well, or the instrument. It's exactly. That much more complex.
And he's a great example because he is such a great investor, and I also love reading any of his materials because I just think that he is just so talented.
Yeah. Another thing you mentioned a bit, whenever you take on a new position, you check how's the risk. How does it fit into the rest of your portfolio? And you also mentioned in your book that risk management is a very important part of your profession, right? How do you check the risk of a trade before you do it? What's your process like?
Yeah, no, risk management at the end of the day is the most important part of this business. To really be successful over time, you need a great investment process that you're always fine-tuning, you're always honing that to try to improve it. But it all needs to be embedded within a great risk management process. So many global macro investors will use a VAR, a value at risk type of framework for to thinking about the risk in their portfolio. And that's really decomposing all of your investments, whether that's across interest rates or foreign exchange or equities or credit or commodities, into units of risk. So you can think about how your portfolio is shaping up at any point in time. I think one of the really interesting things about global macro is because most of the large allocators consider this as a diversifier against a lot of their other holdings, they do expect us or hope that we will provide correlation benefits, meaning when equity markets are most challenged, when you have these risk-off environments, is when they expect us to have our best years of relative outperformance. It's, standing up in those more challenging times. And there's a saying in the markets that, bonds always get things right, that, bonds are always kind of trying to sense out when we're going to be in a period of more challenging economic data. And I think that's very true because of what our investors expect of us. I always say that we're paid to worry, and we worry about a lot of things. But, we are not always looking for the new exciting growth story, but more, where can things go wrong? And what do we need to do to be able to protect our portfolios and protect our investors?
How would you profit from something when the world goes wrong, right? If everybody sees too bright of a future, how do you, for example, it could be any example, right? How do you position yourself for things really going bad and then profiting from that?
Well, I think it's such an important question because historically, the way you would protect your portfolio, protect your positioning is to be in the safest assets, right? And U.S. Treasuries have always been deemed to be very safe. So that is a risk-off trade where they will perform very well when equities are in a drawdown. But what's really interesting, because of the interest rate environment that we've been in over the last 10 years, where we've gotten to the zero bound, bonds provide less protection than they did historically. And so it's a really important question. And this is not unique to just what I do, but if you think about risk parity portfolios or your traditional 60-40 type of portfolio construction, I think one of the biggest challenges for markets right now is what can provide that same level of historical protection that bonds, provided in the past, because it is a changing dynamic. If you think about across the Eurozone where, negative rates are in most places, how negative can rates really go? Will those bonds, provide the same level of protection the next time that, stocks, sell off by 10 or 20%? We don't know.
And especially, you have a management fee, right? You have a performance fee. If bonds are already at like negative -1%, and still, even if investors invest in you, right? You can't just go like, oh, I'll just put all the money in bonds, right? Because otherwise, how do you earn your 1 in 10 or 2 20? That's just, it's not how the markets work anymore. You have to be a bit more creative than that, right?
Well, look, you have to be more creative. And one of the things that I feel like I've been so fortunate about over the course of my career is that the firms that I've worked for, and I've worked for some of the best firms in the world, but their mandate is so challenging. It's to generate absolute returns, to make money in all market conditions. That's what our investors expect of us. And, in the U.S. here, there's a saying with our sport of baseball that, hitting a baseball is the hardest thing to do in all of sports. And you can argue whether or not that's true. But at least in investing, I always like to draw the parallel and say, generating absolute returns in all market environments, I think is one of the most challenging things to do, in investing. And those that are great at it, if you think about some of the icons of the macro world, people like Stan Druckenmiller Alan Howard, Paul Tudor Jones, what they've been able to accomplish over their careers is just amazing. And it's something that I just really respect.
Yeah, absolutely. I mean, this, as you said, they are complete legends. And I think what probably is one of the key traits of one of those investment legends is to perform positively when others are massively underperforming or performing negatively. And that brings me to a topic that I was quite curious about, and that's how to behave as a trader when markets crash. And I think this is very good to see this with this recent example, right? You said it yourself, like the pandemic just had markets crash and then rebound basically instantly. How do you perform in such an environment, right? What goes through your head? What kind of trades do you take? What does it take to keep your calm in such an havoc-wreaking moment?
Well, there's a couple of famous scenes in the book where the main character basically says that in this business you can never panic. That being said, when you're in a period of March of when the pandemic was spreading around the world, we had that 35% peak to trough decline in the S&P. In periods like that, it is always really scary. And the level of volatility that we saw in that 3 weeks was unprecedented. We had never seen that level of volatility before. And when things like the U.S. bond market are seemingly breaking down, that they're not functioning as they should, look, it's hard not to be scared. In periods like that, it all comes down to how you have prepared in advance. Because when the crash is happening, it's very difficult to reposition a portfolio. Again, it comes down to your discipline in following your investment process and making sure that you're comfortable with every risk in the portfolio, and that you feel that it will stand up in a period like that. But in periods like that, when asset pricing are doing things that you just didn't think it all would be possible, and think about that period. You had these great companies, Boeing and ExxonMobil, and some of the biggest companies in the world, and all of a sudden it looked like they were all insolvent, like they were all going to go bankrupt. There was no liquidity. And, I can't imagine anything that is scarier than that. And then obviously, so soon after the Fed announced, their massive monetary policy easing and, new rounds of quantitative easing, everything just ripped right back to the highs. It was just such an extraordinary period. And, for me, it was one of the biggest challenges in writing the book, in that, I wanted to be able to capture this moment in time because it was so unusual, and to do it in kind of the first person narrative of someone, managing through the markets in a period like this. So people could feel just how frenetic the period was, and the challenges and the types of decisions that you have to make, during a period like that. But it ended up being just such an amazing project for me, and so fun. And again, I think that, it's something that hopefully in 20 years, 30 years, I'll be able to look back and say, wow, this is such a unique snapshot of in time that I was able to capture.
Yeah, I definitely enjoyed the intellectual part of it. So there's a lot of your explanations that you do, like how do you buy and sell risk, like how do you trade long and short gamma, what does that have to do, and like all those things, and then also the story side of it. And one thing that I found interesting, you mentioned it, you can't reposition your portfolio during a crisis. I was like, wait, what? Why not? Can you go a bit deeper into why you basically were just sitting there and just waiting while the markets around you were crashing, right? Why are you not shifting your portfolio? Why are you not trading? What happened? What's the reasoning for sitting still in such a tornado?
Yeah, I think that it's in my experience, and I've been so lucky now because I've, starting with the tech bubble meltdown in early 2000s and the Asian crisis in 98 and, the global financial crisis. But I would say that I've probably, had the privilege of trading through 6 or 7 pretty extraordinary types of market events. And I think what always comes back to me is, a lot of people think that there's going to be this writing on the wall. They'll see it coming before it happens. But in my experience, that's never the case. All of a sudden, you're just in the midst of this panic, and there's, kind of frantic selling, and people are trying to square their portfolios. But it's so incredibly difficult because, liquidity tends to really dry up. And if you're a forced seller, you're doing just, damage to your own marks. And it's a really challenging period of time. And again, it comes back to our mandate to make money in all market environments and generate absolute returns. And, to do that, you always have to have a plan. You always have to have discipline. You always have to follow your investment process.
I think that's a good segue to talk about. I announced it a bit earlier that I want to speak about how the markets changed over time, right? You've traded through a lot of crises, and the strange thing is you said it, I think it was 7 crises that you traded through, and probably each and every one of them was a black swan event, that a once in a lifetime crisis, but you all alone in 25 years had 7 of them. How do you see the markets in general, and then the global macro market specifically, change over the last years?
Well, in a lot of ways. I mean, the markets are these, to me, almost this living, breathing creature itself. Because, as I look back over 25 years, look, when I started, technology was so new. Just think how much technology has changed in that period. So the rise of, more systematic and quantitative types of strategies, data is more readily available than ever before. Following the global financial crisis, there have been huge changes in, the role that the large banks can play. They're not allowed to take the same amount of risk that, they did, in the pre-2008 type of period. So all of these changes are monumental shifts in terms of the way you think about your own investment process, the players that you're competing with in the markets. Today, we're competing against, machines, much more than other human beings. And all of these things, they have an impact because they change the markets. And, you certainly can't play the game the same way that you played it 25 years ago, because if you tried that, the markets would have made you irrelevant. They would have moved beyond you. So it's really important to always be a student of the markets and be changing and understanding how the markets are evolving and trying to stay up with that.
How did some of the more recent trends affect your work? So I'm thinking, you said it yourself, systematic trades, and pick any or all of those, like for example, passive investing. How did that change the market? Did it make markets actually less reactive? How did high frequency trading, this machine algorithm trading, affect the markets? And then the last thing, which I'm quite curious about, how did the retail frenzy that just evolved over the last, year with like the whole GameStop, AMC trades, how did that shift the market forces to maybe an entirely different level?
Look, it is such an important question, and it's a great real-life example of how the markets are always evolving. Because this type of retail participation now in those meme stocks that you mentioned, the Reddit names, the AMCs, the GameStops, if you weren't really focused on what was happening in that space, a lot of, really great hedge fund investors really got things handed to them, right? Because they didn't understand the shift that was happening. And maybe the retail side of the equation was less focused on fundamentals and more focused on just the size of short positions and understanding that they could, in this great herd mentality, run people over, which they did. But unless you were seeing that and looking at price action and observing for some of these patterns, I think that for some hedge fund investors, it was easy to get stubborn and say, boy, fundamentally, this stock should never trade here. It's even a better short now. But, fundamentals didn't matter, for those minutes, for that period of time. The only thing that mattered was surviving, right? And avoiding those types of issues if you were on the wrong side of those trades. But I think that the power of the retail investors and what we saw there was, probably one of the most amazing developments of the last year.
Do you have any ways in which you try to adopt your knowledge, your shift? Like, how do you make sure you stay up to date? You see those trends, maybe not in advance, but you keep up with them quickly. Do you have any rituals? Like, I don't know, once a month you speak with your 5 best friends. Like, what do you see? How do you shift your mindset? Or you just like, okay, the trades that worked last year just don't work as well this year? Like, how do you try to adopt?
I think it is, you have to be focused on constant or near constant improvement in this business. Always finding a way to make yourself better, to evolve with the times. So maybe you're looking at new sources of data or information, or you're focused on, hedge fund positioning or retail positioning, or just finding a way to further systematize your own process to make it even faster, more robust, have the computer helping to guide your own decision making. I really believe that, over the next 10 years, we'll continue to see an acceleration of all of these trends. And, Paul Tudor Jones is famous for saying, talking about the man and machine, and combining the best of both. But I really feel that those people that are able to do that, to really continue to systematize their own process, to make it as fast and as institutional, as robust as possible, but also having that discretionary side, because computers and the systematic strategies tend to struggle most in a period like March of last year when the pandemic was spreading, because they don't understand how to probability weight those types of events, those outcomes, the large black swan events. And I still feel that real human beings are best at that, and it's really important. So I think always you're trying to combine the best of all of these worlds.
Yeah, and I reckon machines also would not anticipate anybody buying GameStop or AMC at like 100,000 times their fundamental value. Machines just can't wrap their head around it. So it helps to have like a human look. I was like, yeah, I know it doesn't make sense from a purely economical standpoint, but if you check the mentality of people, then it makes sense, right? Because that's just how people think. They fight not for a valuation, but they fight for not seeing their favorite company go bankrupt or something like that.
Exactly. In this business, it's so important to be pragmatic, to listen to what the market is telling you via the price action, and being able to admit when maybe you're wrong. Boy, I'm wrong here. I need to cut this position. I need to get out of harm's way. It's a really important lesson. After spending 25 years in this business, you realize that as a professional in this space, you're going to be wrong a lot of times. But being self-aware of that and being able to admit when you're wrong and to take the right action is really important. In this business, never get stubborn.
Do you have any rituals? In the book, you talk about circuit breakers, that when XYZ happens, you're like, okay, stop. Was my thinking correct? What do I do now? Do you have any of those rituals that you can recommend other people that to keep yourself in check, right? That you don't give in to your biases too much?
Yeah, look, 100%. There's something that I've always done over the course of my career, which is daily journaling. Every day, write down, what worked, what didn't work, how you responded to certain types of data or events, and learn from that. But I find that the process of actually writing it down on paper so I can go back to it, in the future, is probably the best. It keeps me intellectually honest with myself about the good decisions I've made, the bad decisions I've made, where I should have done things differently. But I think having that type of discipline in terms of doing this and being honest with yourself ends up giving you the best long-term results.
Now, you mentioned a couple of really good characteristics somebody should have to succeed as a trader, as a hedge fund manager. Could you formalize this a bit more? So, for example, also in the book, you talked about the main character let somebody go because they just didn't perform the way it expected. And I just reckon this is how the hedge fund industry works, right? So could you talk a bit about, because our listeners are often students, young professionals in this finance space, they're looking to get into the hedge fund industry. What should they bring to the table nowadays to get an interview and then get hired and then to succeed throughout their career?
The first thing is just a passion for the markets. You have to love this business, and you need to want to be one of the best. And it needs to be one of your top priorities in life. This is something that takes an incredible amount of work. It is not an easy type of job. And the best risk takers, the portfolio managers that I've been so fortunate to work with over my career, and some of the icons of the business, they have this amazing perseverance about them. Whenever they're faced with something that could be viewed as a setback, they use that to learn, to make themselves better. They use it to challenge themselves. And I really respect that. They have this incredible perseverance to want to succeed. And they boil that down into the way they're constantly trying to improve their investment process, the way they're constantly trying to find other great people to add to their teams, to leverage their own abilities. And the best risk takers to me, have this combination. They have this almost heightened self-awareness about what they're good at, what they're not good at, how they need to complement their own skill sets. But it's just so impressive because the best risk takers, they have this amazing conviction in terms of their process, but also their ability and desire to want to take risk and understanding that you have to take risk to generate returns. And they do it so well. It's really so impressive to see.
How do you pick yourself up if you have been wrong, everything went against you? It's a bit of that in the book, right? Like everything just seems to go wrong. Is there any tips, any tricks, any tools that you can use to develop this perseverance? Like, do you say like a mantra every time you're down? You're like, I will be better, I will come next day. Is there anything that gets you going if things look really dark?
It's exactly that. It's a self-confidence that you need to have, which is, look, being in this business, I am going to have setbacks, but I'm never going to let that be a permanent setback. I'm going to learn from it. I'm going to take this challenge. I'm going to make myself better. You can never give up on yourself, and always have confidence that you will bounce back. It's a really important part of this job.
I love it. Do you have any last words, any last tips for our audience before we wrap up?
Well, one of the things, the primary motivators in writing the book was I wanted people to understand my passion for the markets and how much I love this, and to really give people that front row seat in terms of this amazing business that we're all in. So I hope people sense that from me, and I love global macro investing, and it's been a real privilege to speak to you about it.
Definitely, and I highly recommend the book. I had so many notes on what I would love to talk on details about, how do you this trade, how do that work, what's your thinking behind this, a bit particular worldview that doesn't come up every day. And we just didn't have the time because the conversation was so much fun, but you go into a lot of this in the book. So it's kind of a storybook for upcoming hedge fund traders. So yeah, it's both intellectually challenging because you talk about like, what's a relative value trade? Why does this trade lead to that outcome? And I really enjoyed that, but it was packaged in a very entertaining way. So thank you very much for taking the time to write the book, for putting it out there, and for sitting down with me today. It's been really awesome to speak with you.
My pleasure. Have a great day. Thank you.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.